Today I'm going to talk about the capital cost tax factor, which is one of the components to a tax calculation. Now, taxes make things kind of interesting when you're doing, for example, a present worth analysis. What happens is this. As soon as a company buys something, the very act of purchasing that asset creates a whole bunch of future receipts. Because every year from the moment the asset's purchased, depreciation occurs. Every time depreciation occurs, there's an expense that appears on the income statement. That expense offsets some income, reducing profit, and thus reducing taxes that's paid. So if we look at this in terms of cash flow, we have a large expense in the asset to begin with, but a large disbursement. But then we have an infinite series of slowly reducing receipts due to the savings incurred from reducing taxes. Now, what the capital cost tax factor is just simply a number that we can multiply the first cost of an asset by to find out what its first cost is, including all of these savings we're incurring through future tax benefits. So, in fact, our cost is less than it seems. And the capital cost tax factor tells us by how much. Now, there are in fact two capital cost tax factors. The one that applies for assets purchased before Black Friday, the 13th of November 1981, and assets purchased after that date. First, we're going to look at the capital cost tax factor for assets before that date, the old capital cost tax factor, and then we'll develop the new one based upon the old one. Now, let's look at the taxed benefit that can be attained by a company through a purchase. Now, the company purchases an asset of cost P. The depreciation charge under declining balance for that asset in the first year is P times the depreciation rate D. Now, that's going to be taxed at a rate T. But that amount that is being taxed is in fact not taxed because it's depreciation, which is an expense. So that's actually a savings. The first cost times the depreciation charge will be the expense that's not taxed at that tax rate T. So that's the savings for the first year. Now for the second year, the book value of the asset is going to be P times 1 minus D. So that will be depreciated and then not taxed at the tax rate D. So that's the savings for the second year. Or in general, just to reorder these a little bit, it's going to be P T D times 1 minus D to the n minus 1 for the nth year. That's going to be the savings that are being incurred each year in the future. Now, to recognize the present worth of these savings, we have to bring them back to present worth. So each of the savings is going to have to be brought back in time, small n years. So the total savings at time 0 is going to be PTD, because that occurs in each one of these savings, times 1 for the first year, plus 1 minus d over 1 plus I for the second year. The 1 plus I, 1 over 1 plus I is the formula for the present worth factor, plus 1 minus d squared over 1 plus I squared, plus dot 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 1 plus d to the n over 1 plus I to the n, plus dot 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 forever. Because of course, as you recall, with declining balance depreciation, the asset is never reduced in value to 0. Which is a fairly complicated formula. But what this gives us is the present worth of all those savings. Now it so happens we can simplify this. Now there is a series, I forget what it's called, or if even it has a name, but for q is being less than, strictly less than 1, the limit as n approaches infinity of 1 plus q squared plus dot 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 q to the n equals 1 over 1 minus q. Now, the pattern of these series are identical. We have the 1 here. If we call this q, then this is in fact q squared, because both numerator and denominator are squared. And this is an infinite series, as this would be as n goes to infinity. So we can take our 1 minus d over 1 plus I and substitute it for q as long as q is less than 1, as long as this expression is less than 1. Now if we look at this expression, we see that d is always going to be between 0 and 1. So 1 minus d is always going to be less than 1. 1 plus I is always going to be greater than 0. So 1 plus I is always going to be greater than 1. So this will be always less than 1. This will always be greater than 1. So the total thing has to be less than 1. Has to be. So this series applies. We can do that substitution. And what we end up with then is that the benefit, net benefit, is p t d over 1 plus I times 1 over 1 minus 1 minus d over 1 plus I. Which simplifies to p t d over 1 plus d. That's a plus down here, and that's a t up there. The t and the plus are often easy to get confused. Which is in fact a remarkably simple formula, considering the effort it took to arrive at it. So that's the net benefit. What we really want is the present worth of the asset, taking into account all of these benefits. So the present worth of the asset is going to be the first cost minus PTD over 1 plus D, which is equivalently P times 1 minus TD over 1 plus D. This part here is the capital cost tax factor, not the P, but the 1 minus TD over 1 plus D. Because that's a number by which we can multiply the present worth and calculate the present worth of the asset, taking into account all of these future tax benefits. capital cost tax factor. Now, we'll be using this capital cost tax factor when we make economic calculations, taking taxes into account. But what I wanted to do in this talk is simply show you where it comes from and why in fact, it does have meaning. Recall that this is the capital cost tax factor for pre-November 13th, 1981. This, of course, is complicated by the fact that after that date, we have to take into account the fact that the value of the asset is split over the first 2 years. Only half can be included for depreciation calculations in the year it's purchased, and the other half a year later. But rather than going through all that derivation again, we can simply use the old CCTF formula to calculate the new CCTF. And what we do is we recognize that half the value of the asset is depreciated now. The other half only starts depreciating a year from now. So if we take the old CCTF and for half of it start depreciating it a year from now, if we bring that other half to present worth, it's simply taking that whole series of future payments back in time 1 year. So we essentially need to simply multiply half of this CCTF by the present worth factor for 1 year. So we'll pull the 1 out because the 1 doesn't involve well, it's in common between both. Half of the second part stays exactly as it is, as TD over 1 plus D. But the other half has to be multiplied by the present worth factor of 1 over 1 plus I. Now, you see that if I had taken that half and multiplied it by 1 minus, in both cases, the 1's in common, the 1 comes out. And that can be simplified to be 1 minus TD times 1 plus 1/2 I over I plus D times 1 plus T. A more complicated formula, that's the new CCTF, but one which is still workable. And the idea is behind these CCTFs that you can calculate these things once and then use that calculated value for whatever asset is purchased. So it is a time-saving exercise to calculate this CCTF. And we'll use the CCTF in a subsequent lecture in the calculation of the economic effect of taxation on selecting alternatives. Thank you.